Okay, everybody, it's great to have you back. Welcome to Harvard Voices on Climate Change. I'm Jim Stock, Vice Provost for Climate and Sustainability at Harvard. I'm an economist and director of the Salata Institute for Climate and Sustainability. Whether we like it or not, climate change is inexorably creating new challenges and problems. It's barely June, yet Canada is experiencing major wildfires, and northern Minnesota had some major fires in mid-May in near-record mid-May heat wave. Tackling the hard problems of climate change is the pressing work of universities, including Harvard. In this series, we talk with faculty and researchers from across Harvard on the important work they're doing around climate and sustainability. Today, we are visiting the Harvard Business School to get some insights into how climate change is disrupting insurance markets. As wildfires and violent storms increase, so too have the financial losses arising from property damage. This increasing loss burden puts pressure on insurance companies to raise rates, or if they cannot, to stop offering home insurance. In California, increasing wildfire risk and losses have been a proximate cause for a number of insurers leaving the market, and homeowners have increasingly resorted to their California state-run plan, the FAIR Plan. Compounding these issues is the increasing difficulty of forecasting insurance exposure and risk at the very local level. So what does this mean or portend for insurance markets? We're fortunate today to have two experts on insurance and climate who've been doing research on just these topics. First, we're going to hear from Ishita Sen, who is an assistant professor at Harvard Business School. Ishita is in the finance unit there and teaches the Finance 1 course in the MBA curriculum. Her research focuses on the intersection of risk, climate, and finance. Ishita got her PhD in finance from the London Business School. Next, we'll turn to Peter Tufano. Peter is the Baker Foundation Professor at Harvard Business School and a senior advisor to the Salata Institute. From 2011 to 2021, he was Dean of the Said Business School at the University of Oxford. For the last 2 years, Peter has organized a multi-university hybrid course on climate finance run out of the Salata Institute. I could give you a warning. It's a really interesting course, but let me give you a warning. It's a second-year PhD course in finance, so it's heavy lifting. His current research focuses on climate finance, climate alliances, and the financial impact of climate risk and on households. After their opening remarks, we'll turn to Q&A from the audience. I have some pre-submitted questions, but if something occurs to you, please put it in the questions and Q&A. If we have relevant links and updates, we're going to share them in chat. So with that, let me turn this over to you, Ishita.
Great. Thanks so much, Jim. I'm really pleased to be here. So let me share my slides. Okay, awesome. So great. So I really plan to do three things. I want to sort of talk about some of the key takeaways from some of the projects I have worked on in the intersection of climate risk and insurance markets. So first off, I want to sort of talk about regulators and insurance companies and how insurance companies are really navigating the cross-state insurance regulations in the US and what that means for market outcomes. Then I want to sort of take a step back and think about the demand side of the market. So really, what is driving the homeowners' demand in this market? Okay, and finally, I want to sort of talk about the recent trends of really large, good quality insurers exiting the market and how the market is really getting, this gap is being filled by really low quality, risky insurance companies. And then I want to highlight what that means for homeowners as well as the mortgage market. Okay, I want to mention that all of this is based on sort of three research papers that I've worked on, along with some wonderful co-authors of mine. So Simon O. and Pari Sastry at Columbia, and Tess Charlemagne and Anna Maria Tenikijeva at the Federal Reserve Board. Okay, so many of you probably do not know this, but insurance in the US actually gets regulated state by state. And regulations vary really widely across states. Now, that variation in many ways is not necessarily a bug, and in fact can really be a feature of federalism. In fact, states are really different when it comes to their risk exposures, when it comes to the types of people that reside in these states. So homeowners vary a lot in terms of their income, their financial sophistication, their beliefs, and so on. And having this structure basically means, on one hand, states can be completely free to innovate and tailor rules to their own local conditions. But on the other hand, this flexibility, as great as it is, it can also create inconsistencies and can potentially distort market outcomes. And so in our work, we identify one such distortion coming from coming from regulation of insurance prices. Okay. And basically, we show that inconsistencies in regulation across state has led to a decoupling of insurance premiums from underlying risks. So this is a picture taken from one of my papers where I am showing you on the vertical axis insurance premiums or rates. And on the horizontal axis, we have expected losses from FEMA. And we have two different types of states in this picture. On the left, you have states that are less regulated. And on the right, we have states that are really highly regulated. Okay, so what do we see? So on the left, first, we see this really strong positive relationship between insurance premiums and expected losses. Now, this should not be surprising. We should expect to see that insurers would want to charge higher rates in areas that are more costly to insure. Now, while that relationship holds very strongly in these less regulated states, that tends to completely break down in the picture on the right, where you see insurance premiums are much lower. The strong relationship between expected losses and insurance rates sort of breaks down for a large part of the distribution. So we go into the details of exactly what is driving this decoupling of insurance rates from risk. Now, one reason, of course, is the fact that there are these highly regulated states where insurers are not free to update prices. And there are different types of regulation, the types of variables insurance companies are allowed to use, the extent to which they can use models, and so on, all of which really mean that over time, as losses have occurred and as expected losses have gone up, insurance companies have not been able to raise rates at the same level. And so over time, rates have sort of lagged have lagged expected losses. But on the other hand, it's interesting how insurers actually respond to this dynamic. So we show that insurers end up actually cross-subsidizing their businesses in highly regulated states by raising rates in less regulated states. So here's sort of like an example from the paper just to sort of motivate what we are doing. So imagine you have these 4 states, California, North Carolina are highly regulated, and South Carolina and Virginia are less regulated. And imagine you look into around the borders of North and South Carolina. And imagine now also that there is a big wildfire in California. And so we track how insurance premiums go up in North Carolina zip codes very close to South Carolina's border, as well as the zip codes in South Carolina. And we find that actually rates go up far more in South Carolina than they do in North Carolina. And if you sort of look at what happens on the other side, so if imagine there's a big loss instead in South Carolina, prices would adjust locally in South Carolina without spilling over to other places like California, North Carolina, or Virginia for that matter. So there are these asymmetric sort of spreading of losses from high regulation states to low regulation states. And these effects have accumulated over time to give rise to a situation where these less regulated states also have prices that are too high relative to their risks. Okay. And so the question is, well, why should we care about any of this? Well, first off, this means that there is distortion in who is bearing risk. So there are places, imagine like Enid, Oklahoma, which is a place that is less regulated. These places are overwhelmingly bearing the sort of the losses or the risks of places like California and North Carolina. And so that means that there is sort of this blurring of signal from insurance prices. So we might have learned something from insurance prices, but we can no longer do so in many parts of the country. There are places where prices are too high relative to risks. And so in these places, you would worry that people are going to either drop coverage entirely or drop coverage to some degree and would be underinsured. Okay, that leaves them exposed to future disasters. And there are also places where prices are too low relative to their risks. And in these places, people are not bearing sort of the full cost of living in such high-risk areas because insurance prices are too low. And that could potentially prompt more development to happen in these areas and more concentration of assets and people in these areas. And we would also worry about things like the availability of insurance as well as the competitive landscape, because you would expect ultimately that insurers are going to exit these highly regulated states. Great. So with that, let me sort of turn to another project of mine where we look at what is driving demand in this market. Now, I must say, for the longest time, we've been wanting to do this exercise, but we've not been able to, because beyond aggregate statistics at the state level on the coverage amounts and number of people that are insured, we really didn't have much granular data to really look at how covered people are. But now, with advancement on the data front, at the loan level, we are able to observe what coverage choices people have made and what premiums they're paying. And we can link all of that back to the borrower and how much debt they are taking on, as well as to the property itself. And so we know something about the risk of the property. Okay, so I'm showing you two pictures. On the left, we have what coverage ratios, so the fraction of the replacement cost of your home that you have essentially insured, how that looks like across the US. So you have states that are in dark red where coverage ratios are high, so about more than 80%. So these are states like California and parts of Northeast. But equally, in light yellow, you also have states where these coverage ratios look really small, so even below 50%. Now, if you stare at this graph, it sort of becomes apparent that this doesn't seem to correlate with risk in the way we would want to. In fact, some of these states in the Southeast are actually very risky, and yet people are really are taking on less coverage in these states. If you zoom into what's going on at the loan level, so the picture on the right, we are looking at what fraction of people are severely underinsured, meaning they don't even have 50% coverage. By different ventiles of income. And so what this is saying, for really low income people, about quarter of them don't even have 50% of their replacement cost covered. And that diminishes as you go up the income distribution and becomes it's not a problem for really high income people, but at lower incomes, severe underinsurance is really prevalent. And this, by the way, actually also is true even when you sort of only looked at really high risk properties. Okay, so in the paper, we get into how are these households and responding to increases in premiums, and we find that even when prices are really close to being actually fair, households have been dropping coverage as premiums rise. And this is very contra to economic theory, because you would think that risk-averse people should actually want to have full coverage amounts. In fact, some of our models would suggest. And so we show that actually financial constraints are driving this pattern. The constrained households are dropping coverage, but the unconstrained people who have some borrowing capacity, they are actually increasing their debt to finance their insurance premiums. And so what this means is that there is sort of this low willingness to pay driven by financial constraints. And there may come a point when the willingness to pay may even fall below the expected losses required for insurers to remain solvent in this market. And so there might be no gains from trade. And you might see the market could disappear for the most financially constrained households, but also the ones that are currently unconstrained. Even them, because they're taking on more and more debt, they would start to hit their binding debt constraints, and they would also at some point start dropping their coverage amounts. Okay, I wanted to say, quickly show you some aggregate trends that support these patterns. So this is sort of evidence from Florida, where I'm showing you what's happening in the last 5 years. And what you see is that premiums have been going up, not surprisingly, so about a 30% rise in premiums. Coverage ratios are declining. And the right-hand side, the picture on the right, shows you how debt levels have been changing. And so there is also this really large increase in loan-to-value ratios in Florida during this time frame. Again, consistent with the patterns that I was describing before. Great. In the last few minutes that I have, I want to talk about this recent trend of insurers actually exiting some of the riskiest parts of the country. So really good quality national players exiting the market. Now we know that the gap is being increasingly filled by insurers of last resort or the FAIR plan. So that's something that we know is happening. But also at the same time, really another worrisome trend is that this gap is also being filled by really low quality risky insurance companies. So what I'm showing you again, this is a graph for Florida, where you see this red line, which is these are basically insurers that are rated by this one rating agency called Demotech. These insurers collectively hold about 60% of the market share in Florida today. And this is coming at a time when some of the traditional insurance companies, so the national names, all states of the world, they are the ones that are sort of exiting the market steadily. Now, these Demotech rated insurers, they are small, they write in risky areas. So think Florida, think South Carolina, Texas, Louisiana, and so on. They're also really less diversified. So often single state insurers, they tend to hold less capital. And perhaps the best evidence I can provide of their fragility is the fact that about 1 in 5 become insolvent in over a 10-year horizon, while that number is almost 0% for some of these other traditional insurers during the same time frame. Great. And so one question is, well, how do their ratings look like? Now, ratings are really important for this market because the GSEs, that is Fannie Mae and Freddie Mac, for them to accept a mortgage and securitize a mortgage, they require that the property insurance company backing the mortgage should have a certain rating threshold. So Demotech ends up rating all of these insurance companies and basically gives them an A rating, which means all of them are eligible to be all of these mortgages are eligible to be sold to the GSEs. But actually, we show that many of them would not be eligible under the methodologies of other rating agencies and the more traditional ones like AM Best. So I want to end with what all of these trends that I showed you about the Florida market mean for households and mortgage markets overall. So one key thing to note here is that having a really risky insurer backing your mortgage is bad news for you in the aftermath of a disaster, because we see that these mortgages tend to default in a disproportionately high number after a big hurricane. And banks are aware of the difference between a good quality and a bad quality insurer. So they screen out mortgages backed by low quality insurers as long as they retain these mortgages, or what are called jumbo loans, on their balance sheet. But they tend to actually not screen in the same way mortgages that they are allowed to offload to the GSEs. And so the combination of the behavior of banks and the miscalibration in this property insurance requirement of the GSEs is sort of another way there is a blurring of market signal, not about prices, but about the availability of reliable insurance. And there is the sense that there is this mirage of having really high quality A-rated insurers, whereas their balance sheets actually do not support that A rating. And what all of this really means, given how banks respond to these developments, is that there is too much credit supply taking place in the GSE segment of the market, which is ultimately bad news because there's going to be more concentration of assets in really risky areas backed by really risky insurers, putting people at risk even without sort of a big increase in natural disaster. So with that, I'm gonna stop right here, and I'm gonna turn things over to Peter.
Great, thank you, Ishita. So first of all, I want to thank Jim for organizing this and Ishita for those great remarks. And thank you all for joining. When you do research on insurance, you're never quite sure how many people will show up. It's not the most popular thing at a cocktail party, let's just put it that way. But what I'd like to do is to build on what Ishita has done. And I'm just going to, word of praise. There are a handful of really top scholars in this field, and Ishita is one of them, a new generation of scholar who's doing really, really great work. So you just heard from among the best. I'm going to try to provide some context in the sense that what Ishita has described very, very well is the US insurance market. There is, however, an entire globe outside of the borders of the United States. And as much as we don't know about the US insurance market, we know even less about the global market. So hopefully in the next 15 minutes or so, you'll get a sense of what the rest of that market looks like, which has slightly different issues than the ones that Ishita has raised. So I'm going to cover 4 or 5 things quickly. One, perils and losses. Let's look at a global set of data and a time series over the last 30, 40 years. Second, what are the global differences in insurance coverage? How is it that what Ishita has described in America, it turns out is more the exception than the rule? Next, what is the difference between the developed and developing worlds and insurance coverage? What are various market failures that have been identified largely by governments? For example, I'm going to show you the UK, one of the UK regulators, the PRA, and what solutions there might be to the underinsurance problem. Then a couple of success stories about prevention, and then the opportunities and challenges of collaboration. That's a lot to cover in 15 minutes, but I talk fast, so let's see if I can do this. Start with some data, and I'll just say a word about the data. The best macro data for the insurance industry is coming from the insurance industry. So you're going to see on each of these slides a source, Munich Re, Swiss Re, McKinsey, some others, and I'm going to shamelessly use their data, but give them full credit. This is from Munich Re, although you can get a similar picture from the other major sources. This is I'm going to say Nat Cat from time to time. This is natural catastrophes. This includes all the things that you're normally used to hearing about, which is earthquakes, which are going to be called cyclones, and then convective storms and floods and wildfires and everything else. If you look at the total amount of damages over the last, well, from 1990 here, excuse me, 1980, you see that they're going up. That's the darker blue lines. And this is a trend that has been going up for many, many years. The light blue lines are the amount that are covered by insurance. I'll get back to that later. But the first kind of aha is that these losses are really going up across the world. We think of this largely from America based on the experiences that we've seen. So it's about wildfires. It's around hurricanes. And in fact, that's true. This graph is a cumulative count, or not a count. On the right is the count. Let's focus on the left. This is the total amount of global economic losses by peril. At the very, very top of that scale, which is basically $2.3 trillion of losses, is tropical cyclones. A cyclone is a storm. If it's really severe, we call it a hurricane. Next is flooding. We don't think about flooding so much in America, but flooding is the #2 global economic loss. The next is earthquakes. Earthquakes are not climate related. The next under that is severe convective storms. Think of hailstorms. Under that is droughts, winter weather, and then if you go to the orange near the bottom, 232 billion, that's wildfires. Now that number is going to double because, or more than double, because the 2025, we started out with a doozy of wildfires. So that number will roughly double in the next year when the next year's data comes in. But just to put it in perspective, if you look at the storms the perils that have caused the most damage worldwide, it is tropical cyclones, flooding, earthquakes. And it's not to say that wildfires are not important. Globally, however, they're not as much of a feature as we think they are. And that's because if we look at the last year, and this goes to Aon, I'm switching sources here. This is, the big economic losses last year. And if you look for those yellow dots, they tend to be in the United States. And we see the bigger ones, which is Hurricane Helene and Hurricane Milton. And you can see around the globe, there's different kinds of perils in different kinds of places. So again, this is just to sensitize you to the fact that the global peril market and insurance market is going to look different than the US one. You can also see it here. If you look globally, dark blue is tropical cyclones, lighter blue is flooding, and green is severe convective storms. Up here in the middle where it says USA, you can see we are basically a hurricane place. Right? In 2024, more than half of the losses in the United States were due to tropical cyclones. And the rest of it is severe convective storms. This is hailstorms and high wind storms. Whereas if you were to go to Europe, or in truth, this is EMEA, it's really a flooding phenomena that we see. That 2/3 of the losses in Europe are flooding. And in other places, the perils are different. So we just have to acknowledge that climate change affects different kinds of communities in different ways. Now, there's a number here, which it looks like the US, EMEA, APAC, and Americas are all equal, but that's just because it's the way this is scaled. Really, the US is of the $268 billion of losses in 2024, the US is 218 billion of those. And you'd say, okay, American exceptionalism. Why is that? Is it because we're hit with so many more storms? That's not exactly the story. The story is, when you think about it, simpler. What I just showed you was economic losses. Economic losses are a function of two things: likelihood of loss and then cost of loss. If you think about likelihood, it's about putting risky buildings in risky places. If you think about cost, it's severe storms and expensive to rebuild, all of which is being driven from extreme weather, all of which is being exacerbated by higher greenhouse gas concentrations. So why does the US end up at the top of these lists? Sorry, wrong direction. It's because we put a lot of stuff in risky places, and we have a very expensive economy, and therefore rebuilding costs are extraordinarily high. So we win this race because we are, we do those two things. And this is not a time to talk about social cost of carbon, but similarly, if you look at calculations of social cost of carbon, which is the costs that greenhouse gases inflict upon society, they're going to look like they're high in places like the United States because there's a deterioration of economic activity. This is just physical loss mostly. So what I just showed you is that the US is different from other places. This is another way to see it, and I want to use this to focus on one other thing. So if you look at the leftmost column, here credit goes to McKinsey. This is average yearly natural disasters in number. And so we have seen additional, the number of disasters, this is Nat Cat, are up 52% between this earlier period, which goes through 2015, and the later period, which is through 2023. Non-Americas, the numbers are going down. EMEA, APAC, you see slight increases in disasters, which you see as much larger increases in the column here that says natural disasters, economic losses, dollars billion. There we see where the numbers are going up. So the difference between these two is really the economic cost. But where I want you to focus is neither of those, but rather here. If you look at the United States, 55% of all losses are covered by insurance. If you look at the rest of the Americas, that's 22%. If you look across Europe and the Middle East and Africa, that's 26%. APAC is 14%. Globally, it's 34%. The US is the exception. We are a highly insured region, and I'm going to show you a little bit more granular data. So in the US, we worry about people dropping out of the insurance pools. In other parts of the world, they're not in the insurance pools in the first place. You can see that even better with this slightly more complicated picture. Let me try to describe it again. Thank you to McKinsey. Along the horizontal axis is GDP per capita. So as we move to the right, you're getting to richer countries. On the vertical axis is, it's a summary measure, which is total amount of insurance premiums paid normalized by GDP. So for every dollar of GDP, how much do we pay in premiums? This is a flow against a flow. So as you get higher on that list, you're basically in more insured places. And what you see is that here we have the United States, which is what Ishita's been studying. And the size of the circle is the total amount of personal insurance premiums. So basically, this is size of market. We have a big insurance market. And by the way, GDP or premium to GDP is extraordinarily high. If we look down here at India, India's got 1.3 billion people. It's got far less GDP per capita and is almost, it's among the lowest insured countries in the world. And so what we're seeing if we kind of zoom back is that we are looking at the most developed insurance market in the world. Even if you look at much of Western Europe, it's not nearly as insurance developed. Yeah, Canada and Finland here, but Germany, Spain, Italy, these are far less developed in terms of insurance markets. And then when you get down here to China, Brazil, Ukraine, Vietnam, India, again, to try to get the full picture of what's going on in insurance, it's different in the US than other places. Here, we're worried about people dropping out. Other places, they're not in the market at all in the first place. So one way to think about then is how is it that we get to these insurance gaps? An insurance gap is under or uninsured people. So the picture you had before, which is the flow diagram, likelihood and severity of perils, increasing wealth and economic activity leads to greater Nat Cat losses, leads to rising cost and lower availability of insurance. Ishita's explanation for the United States and description of the United States is in a high income or insured country, the rising costs and lower availability means that the demand for insurance is going to decrease because it's primarily a price effect. And as a result, we see bigger insurance gaps or bigger risk inequality, which is that you have to bear it on your own because the poor are dropping out. And that's precisely what she showed in her paper. We don't really have the studies for the other countries, but here's a hypothesis, and it's nothing more than that. We don't generally see low-income folks obtaining insurance in lots of other countries. So what might be happening there as increasing wealth and economic activity goes up, we might see increasing demand for insurance from the wealthy. Maybe. And that might lead to, again, a bigger gap in insurance, not because the poor are dropping out, but the wealthy are opting in. That is a hypothesis. There's great research to be done in this. So how is it that you might want to address this if you were in the insurance industry, or if you were a regulator, or you were a central banker? And so I want to focus on that for a moment, because these insurance gaps are something of great interest to central banks and to other financial and other policymakers. So right now I'm in the middle of writing a case about what's going on in Italy. So if you want to look at some data to begin with, Nat Cat losses in Italy were 6 billion euros last year, which is a lot of money, but nowhere near the kinds of numbers we're seeing in the United States. Overall, 5% of firms had coverage for Nat Cat, which is, think about floods, hurricanes, convective storms, all that. 5% of firms had coverage. Well, if you look at that, it's like virtually every large firm and almost no micro enterprise. And you can see the only way you can get to 5 is that a lot of the Italian economy is micro enterprises. But what happens when a Nat Cat kind of event occurs and firms are kind of shut down or destroyed? It means employment goes away. It means that services in villages and towns and cities get compromised. So the Italian government, following the lead of the EU, has said, we've got to do something about this. The EU has come up with a number of different schemes. The one that the Italian government came up with, which was just announced in January, looks like this. All companies with Italian headquarters must purchase Nat Cat insurance for buildings, plants, land, machinery, etc. It doesn't protect you against operating losses. The policies have to have a deductible not exceeding 15% of damages, at least up to $30 million. Sorry, there's an M missing. Insured. Tiers of compensation can vary with coverage limits. Existing insurers are required to offer policies, but free to set the premium. And something called SACE, the state-owned export credit agency, is providing a reinsurance fund of 5 billion euros. Why did the Italian government do this? Because the conclusion is that these Nat Cat losses are not only harming businesses, but they're giving rise to large externalities to communities, and therefore they felt it was important that there be coverage, because right now virtually nobody is covered. So the 5 billion, if you look at that number, the government's willing to back, in some sense, up to 5 billion when last year's losses were 6 billion. Now, it really means that the insurers, they're going to cover this themselves. But to the extent that things really go bad, the government's behind this. So this is a very explicit scheme about saying, let's get the biggest pool we can so that we can cover everybody. But by having a large pool, we can also spread the risk and also spread the price. This is different than the UK. The UK, the Prudential Regulation Authority, or PRA, is one of the 2 big bank or financial service regulators in the UK. In a report that they came out with a few months ago, in talking specifically about insurance, they said there are 3 core climate-related market failures. And as a financial economist, and Ishita and I are a financial economist, and Jim is an economist par excellence. We know what market failures are. That's when the private market cannot solve a problem. And so PRA is saying there's 3 market failures. The first one is an information gap, right? Having done a variety of stress tests, and I wrote some cases on their stress tests, basically they're saying, insurers don't really have the information they need in order to, or they're not using it effectively in order to assess damages. Second is the tragedy of the horizon. They're being way too short-sighted. And specifically in the first set of stress tests, the insurers said, oh, we'll just pass the premium increases on to consumers. And that works in the short run, but not in the long term. But the third market failure that the PRA identified was very different. I have a whole quote here because I don't want to paraphrase it. Firms face short-term competitive pressures, which disincentivize them from incurring the costs of improving their climate capabilities and systems when competitors are not making similar efforts, even if in the medium term, this investment might pay off, especially if undertaken by all firms in the market. This is a coordination failure. There's a great paper on the banking industry that shows precisely this, which in that doctoral course that Jim talked about, we cover. So can it be that competition makes us stupider, or at least has a race to the bottom? That's what this paper shows, and that's what PRA is worried about. And so therefore, where might you want coordination? Well, you might want coordination in terms of skill building and capability building, in terms of data so that insurers can make better decisions, but there's other places for coordination. And in the UK, there's a specific example, which is Flood Re, which is a kind of a collaborative project across all the insurers about how to deal with floods. Remember, floods are the biggest risk in Europe. And so where might this collaboration actually produce a result? So over here, you might say, well, if we can collaborate, we might be able to come up with ways to have fewer buildings in harm's way. This could be adjusting zoning codes or flood defenses. If we collaborate, and we as the insurance companies and governments, maybe we can have lower costs of loss, which is changing building codes and practices. And then finally, if we want to go back upstream, maybe what we could do is actually mitigation activities. We as insurers could say, well, you know, we could get on the net zero train and really support net zero companies and climate solutions. And there are temporary solutions. I think Jim's done other sessions on solar geoengineering, so I won't describe that, but it's kind of short-term fixes. So there's all kinds of scope for collaboration. And it's interesting that the PRA, which is not exactly a socialist organization, is saying that we need more collaboration. And these are the places where you can find it. But of course, that will never happen, except that it has. And this is the inspiring part of this story. And I will answer the exam question that Jim put at the outset. So if you've ever picked up a lamp and you looked at the bottom, you might have seen this symbol on the bottom. It's Underwriters Laboratory. The story of Underwriters Laboratory, it was 1893, and there was this problem, which is this technology called electricity was being introduced inside homes and businesses. And as a result of this technology, you're seeing massive amounts of fires. The insurance industry got together and they said, you know, rather than price this, it would be better if we could just reduce the risks. And so they created Underwriters Laboratory, which is a set of standards for electrical appliances and much, much more since then. Because the conclusion was, we would rather reduce risks than price risks. And this has been remarkably successful. I'm of a certain age. I've never had a lamp blow up and create a fire. And I think that's in part to the great work of Underwriters Laboratory. Some 60 or more years later, the insurance industry in the US faced another issue. At the end of World War II, we were building these really beautiful superhighways and we're putting these super heavy, beautiful cars on them, and they were having accidents and people were dying. So they were seeing mortalities going up. And again, the insurers said, wait a minute, you know, we could price this and just increase auto rates, but wouldn't it be better if we could reduce the number of fatalities on the road? And they created something called the Insurance Institute for Highway Safety. And the things on the right, this is the product of IIHS, which is this thing that you'd never hear about, but really has been in the background trying to get greater auto safety coming from the insurance industry. These are both collaborative ventures in the insurance industry. So, and what these are, I'm not going to spend time on this. These are just examples of systems change where they've mapped the system, they found intervention points, and they've built a coalition. Well, certainly no insurer would actually do this, but in fact they are. I wrote a case about Aviva, and the picture on the right is actually not a HBS picture. It's a picture out of an Aviva strategy document, which says, where can we intervene with others to influence things like zoning codes and net zero and everything in between? They have an explicit influence strategy that can, possibly, kind of change the trajectory of the losses that they and others are going to face. Let me just close up quickly because we're running out of time. But would these things ever work? On the one hand, you can imagine that these alliances would work, whether the insurance industry or others. They could develop capabilities. That's what PRA was looking for. Joint ambition, accountability structures, which is, say, reporting. And there's a paper that I reference here that I wrote. On the other hand, they might not work, or worse yet, they might cause various kinds of negative outcomes, specifically collusion. And so what you see there are these little pictures. This is a lawsuit, a big lawsuit that's going on right now against financial firms about joining net zero alliances. This is a letter from the Congress, from the, under the Biden administration, from the Republican committee to all the insurers about why they were breaking the law, or that this is a case study they wrote about the destruction of one of these alliances. So the question is, if we follow the PRA's advice, and we create these collaboratives, are they going to cause more harm than good? So you have a reference at the bottom. I'm not going to kind of do this paper justice, but what a colleague and I have studied are 11 major alliances. 3 of them are in insurance, and the rest are in other parts of financial services. And the bottom line, if you go all the way to the right, is these alliances seem to be somewhat effective. Members who are these financial service firms have adopted environmental practices, adopted targets, slight emissions reductions. They've increased their green lending. They have lobbied on a pro-climate side. And then on the other side, despite the allegations to the contrary, there's no evidence of antitrust markers. There's no evidence of reductions in lending to oil and gas. There's no negative impact on shareholders, and there's no evidence of anti-climate lobbying. So if we put all this together, functionally, insurance provides a way to transfer risks, but this global private risk transfer is very unevenly available. Climate change is increasing the amount of the risk that's borne by all of us. This will increase the price and attractiveness of offering and buying insurance in both developed and developing markets. It should say increase the price and decrease the attractiveness. And the various solutions are to price, which is what Ishita was talking about, better pricing signals. But in other settings, perhaps what we want to do is mandate insurance to create larger pools, but with pricing signals, or even better as prevention. And then collaboration is a tool maybe to work towards prevention and to close. Modest success so far. With that, I'm going to stop sharing, say thank you, and turn it back to Jim.
That's great, boy. There is a lot to unpack, and this is all pretty technical stuff, but it's fascinating. I think I have a bunch of questions from that were pre-submitted, and if you have a question, please put it in chat. So I actually think I might start, Ishita, with you. So can you you went through something really quickly that I think is quite important, and I'd like to go back to the Florida market situation. And you talked about the Demotech insurers. I wonder if you could explain, just back up for those of us who don't do this all the time, and explain the Demotech thing versus the AM Best thing. But then most important, then the second part of the question, and this is something, the second part of the question is, my understanding is that there was some major legislation around insurance in 2022 in Florida, and that seemed to change the number of insurers that were going, the number of policies that were held by the state backup plan, and new insurers entered the market. So this is a two-part question. One, can you just explain this problem that you're concerned about these low-quality insurers and where that comes from? And second, does that have any relationship to this 2022 legislation? Maybe it doesn't. And if it doesn't, can you just say some comments about whether that 2022 legislation is a way to solve some of the problems that Florida was facing and that California is facing in terms of people dropping out? So that's kind of a mouthful, but okay.
Yeah, no, that's super. Well, thanks so much. I was sort of rushing through some of the last slides. So yeah, let's just back up for a minute. So I talked about ratings. So I think first off, let's understand why ratings are even important in this market. So of course, consumers really place a lot of weight on that. You do not want to buy insurance from a C-rated company. You want a highly rated company. So that's one part of it. The other part of it,
they pay your claim, right?
Yes, because you don't want the insurer to become insolvent precisely when you want them to pay your claims. So you have to make sure that you are sort of giving your money to a good, financially sound insurance company. But also another sort of key stakeholder in all of this are lenders and the GSEs, because remember, like they are giving out the loans to homeowners, and if the homeowner defaults after a big wildfire, let's say, they are going to be left holding the bag. And so there are many reasons, of course, homeowners may default, but one reason could be just simply that their insurance company doesn't pay up, and they are in the aftermath of a hurricane. And so insurance companies, property insurance companies are key counterparties to the GSEs and lenders. And so they also have skin in the game. They want to make sure that the insurance companies have a certain rating. And in fact, the GSEs only screen insurance companies through ratings. And so there are 3 different rating agencies that they accept, in fact, 4 now. So let's talk about the 2 most important ones, Demotech and AM Best. At least in the context of Florida. And so for both of these rating agencies, they have some rating thresholds, meaning it would say as long as the insurer backing a mortgage has an A rating, then GSEs are willing to accept that mortgage from lenders. They have many other criteria to do with FICO scores and other stuff, but this is like a key requirement when it comes to insurance. So that rating threshold is A for Demotech and B plus for AM Best. Now, what happens if you sort of looked at the distribution of ratings that Demotech gives out, you realize that all of the ratings are basically an A rating. There's a huge bunching at sort of the A rating, A threshold. And what we do in the paper is try to understand to what degree are these ratings justified. And so we build our own AM Best rating replication models to predict what AM Best would have done with these Demotech rated insurers, because obviously we do not actually observe a AM Best rating, but we can predict based on observable characteristics of the firms, of the insurers, what AM Best might have done. And so that shows that a lot of these ratings would not be at an A level. In fact, many of these companies would not meet GSE eligibility. And now the reason why all of this is important is, look, in Florida, big insurers are exiting. There are stakeholders that would want insurers to exist, because only then we can continue this game of originating mortgages and people having homes whose values don't crash and so on. And so you have this set of insurers that are A-rated that are able to sort of continue playing that game, because you have all of these insurers. You can now happily sell these mortgages to the GSEs and so on, and the game goes on. So that's, sorry, my really long-winded answer to your first part of your question, but super quickly, I do not think that the 2022 legislation necessarily solves stuff, because the Florida market has sort of seen these cycles over and over again. So the reality is that whenever the FAIR plan of Florida has become big, they have done something called a depopulation, where they invite private insurers to take policies out of their balance sheets and onto the private insurer's balance sheet. And so this is another one of those cycles where you see these private insurers enter the market, and the size of the FAIR plan of Florida has been shrinking as a result. But what happens in a few years after a big storm, some of these insurers, because they are not financially very good, they go under, and then all of these policies end up being back in the FAIR plan's books. So yeah, it remains to be seen. I want to also mention that we really don't have great data. For a lot of things, we have been making progress, but for a lot of things, we are not. And it is a little bit difficult to actually say things for sure because of the lack of data. But my sense is that things haven't really changed, because we do not see the big insurers coming back to Florida. It is the smaller players that are coming back again. It's sort of the same pattern.
That was extremely helpful. And so your concern is that it looks like Florida is now being repopulated by insurers coming back in, but actually these insurers are pretty local, highly exposed, and somebody like the feds or the state or somebody's going to end up holding the bag anyway.
Yeah.
So
yeah.
And the home equity again, that's a really interesting.
Right. And so after 2022, after Hurricane Ian happened, 3 or 4 of these insurers went under, by the way. So again, so it seems like we are in that cycle. Mm-hmm.
Okay, so I had a question for Peter, but actually in the interest of time, I'm going to go to the audience Q&A questions, okay? So as people who listen to this know, I really like the weeds. So I have to start out with some weeds questions here from the audience. Are there, what are the best ways, and I think this is probably an Ishita question, but either jump in. What are the best ways for potential residential property owners to actually assess their real risks? So there's NOAA maps and there's FEMA maps, and there's climate models, and insurance companies have these models, and we actually know that the quality of the insurance models really differ a lot from one company to another. There's a wonderful paper by Meredith Fowley and colleagues that that documents that. How does like a normal person know what the risks are going to be to a particular property?
Yeah, no, exactly. And that's why it's so important for insurance prices to be a good signal of risks, because that's sort of one way households could learn potentially. I would say that Redfin, for instance, does these climate scores at a property level. So when you go buy a property, you can observe what Redfin thinks your likelihood of your property flooding or having like a big hurricane, etc. So I think that's a pretty good, and so that's basically, I think, drawing on first streets property level risk measures, and that's what they are showing at a slightly grossed up level. There are other data providers like CoreLogic, which we use, by the way, in some of the maps I was showing you. But again, like these things are very hard for homeowners to buy on their whole. Like these are expensive models and so on, and so you would rely on agencies like a Redfin providing that service. Peter has, of course, a lot to say
No,
on
well,
this.
I mean, in addition, if you're by the coast, NOAA has pretty good maps of sea level rise that you can use to try to model what's going to happen to your summer house, which I do on a regular basis, try to figure out, like when we'll be underwater. There's questions about how good that data is, but it is freely available and fairly easy to use. So, but I'd agree the Redfin, the First Street data is probably, easiest to use for consumers.
The NOAA thing is called, if you just Google NOAA sea level rise viewer, it's quite amazing. So I'll give this as a homework assignment. Do the NOAA sea level rise viewer. Is going to ask for the zip code, put in 02138, that's ours. And then raise sea level by about 1.5 meters, which is a reasonable projection, 1.2 meters, which is a reasonable projection for like 2110 in Cambridge, and take a look. It's kind of shocking. So it's a very interesting picture. Okay. Okay. So another question. Okay. So Ishita, this is probably for both of you. Could you explain why how reinsurance works? And if we think about climate change in Florida or hurricanes as Florida is not being diversifiable, so that these small firms might go under, a bunch of them, when there's a hurricane, surely there's reinsurance markets. Why aren't we able to address some of the risk that you're concerned about in this very standard market-based way? But first, explain reinsurance.
Yeah, the simplest way to put it is an insurance company buying insurance from another insurance company. So that's basically what a reinsurance is. So it's one way these companies manage their risks, which is to, insure like really big loss events that they might have. And in fact, in Florida, you do see some of these small insurers that I was describing actually have a lot of reinsurance. So about 40% of their premiums are typically reinsured, as opposed to actually much lower number for some of the traditional insurers. The problem with reinsurance is, first off, there is sort of limited capital in this market, and the prices of reinsurance contracts tend to be pretty expensive. And we shouldn't think of it as like a permanent capital. We should basically, in the aftermath of a disaster, you would get your reinsurance company to pay up, but the next year your premiums are going to go up as well. So that's sort of a concern. The other concern is, in certain parts of the country, you're not allowed to pass on the reinsurance costs to consumers. So the extent to which, that's sort of another reason why insurance companies sometimes do not purchase reinsurance. So there are sort of impediments, and this is all the sort of the details of the rate regulation across the US. So for instance, that's sort of the case in California. So there are reasons why insurance companies actually sometimes do not purchase enough reinsurance. It's a low number for some of the property casualty insurance. Yeah, Peter, sorry.
Yeah, no, I could add to that. In addition to the insurance, there's capital markets instruments, insurance-linked notes and cat bonds, which perform a similar function. And interestingly, there's this space within insurance called parametric insurance, which is taking a form that is more amenable in some ways to these kind of bundling of risks. So parametric, which we could get into, instead of saying, let me go to your house and see if you had a loss, says, let me look at some index data, the wind speed that your location experienced, or the number of inches of rain that your location experienced, and automatically pay you when you hit those triggers. That you can imagine, some of the stuff I'm reading right now, is maybe more interesting to some reinsurance pools because it probably allows them to price a little bit easier. And Ishita said it's expensive, but based on your research, it's not obvious that reinsurance is expensive. It may just be capturing their economic assessment of the losses plus the capital return that they have to earn on the money that they're putting to work.
That is true. And if I can just take 30 seconds, we know so little about the reinsurance market. And again, I'm going to make the data pitch because I always do. We just don't know much about this market, in part because there is just no data on reinsurers. And we don't know, therefore, how much of it is markup, how much of it is really them charging expected losses. Or it is definitely not that, but something is in between, and we don't have a way to tell the two apart.
And the international stories I was telling, if you think that US data is limited, the international data is even more limited. Mm-hmm. This is one of the most important but most opaque industries, maybe not opaque, but the hardest to understand industries in the world.
This parametric insurance idea is a really appealing one, but I guess my understanding also is that there's a lot of devil in the details there so that you actually get the product that you want, and does it pay off? And what if you have 8.7 inches of rain, not 9 inches of rain, and that sort of thing. So it's a really interesting, but a fairly novel or new market.
It's not so new though, Jim, because I wrote a case about these like 15, 20 years ago in the ag sector, because, sending out folks, to look for every crop and see whether something happened or not. To use weather stations is just a whole lot easier, and that's been happening for a long time.
That's fair. That's right. So I'm going to go back to a question that's directly in Peter's court, based on what you were presenting. So there's a couple of questions that are floating around here. Do you see pension funds joining insurance companies in a pro-climate coalition? And I think and then let me just add to that. The case you wrote was not about the success of Underwriters Lab. It was about the failure of the
That's their insurance alliance.
Yeah. The international climate insurance alliance. Do you actually? What would it take for let's be serious about this. What would it take? What are the underlying impediments to that? And what would it take? And it seems like there's important differences between this and the Underwriters Lab example, where Underwriters Lab certifies that your outlet adapter works, and great, my outlet, I get to sell it and I make some money, and it all works. Whereas here, you're asking governments or individuals to make major changes in their emissions, and how does that actually even work? So maybe you could elaborate on these concerns.
There's a couple of questions in there. One is, do insurers join with pension funds? And yes, remember that the right-hand side of an insurance company's balance sheet is liabilities, which are the policies, but the left-hand side are investments. And most of the major insurance companies, who are also major investors and asset owners, many of them do join along with pension funds in the same alliances. Where's the alignment? There's actually not a bad alignment if you think about the far right-hand side of that picture that I drew. The insurance industry and insurance commissioners would love to get together and make sure that, for example, building standards are improved. This is very much like Underwriters Laboratory.
Yes, right.
In fact, there's a group that I didn't talk about, which is IIBHS, which is the Insurance Institute for Business and Home Safety, which is not as well developed as UL or IIHS, which does that. They have a set of standards for fortified roofs and kind of fortification for wildfires and other things like that. The interesting kind of interplay there is, politically, I think insurance commissioners are very hesitant to tell who are elected officials, the people in their regions, by the way, you have to spend money to fix your house.
Yeah.
And so that's why the idea that a coalition that is both insurance companies and not just insurance commissioners, insurance industry and insurance commissioners, but also local building, code enforcers, not the people who set the building codes. It's in everybody's best interest that a roof doesn't fly off in the middle of a convective storm. It's in everybody's interest that we're as flood resistant as we can be. But the problem is that nobody wants to move first, because whoever moves first is going to get a lot of kind of arrows in their back. And so that's why these coalitions can be extraordinarily valuable. Now, if you want to take it all the way back up to net zero, yeah, that's tough, because most insurance commissioners in private may agree that they understand the kind of the science between climate induced extreme weather, but getting them to politically say that is a much more complicated proposition.
Okay, well, we are at the time limit, and I'd like to end these things on a positive note. And I think that the positive spin will be that there actually are channels for these alliances that could make a substantial difference in terms of things like home safety and so forth. That's not solving the climate problem, but it's solving a piece of it that really matters to individuals. So thank you so much. This has just been tremendously interesting for both Ishita and Peter. I'm really grateful for you taking the time out of your day. I'd also like to thank the Harvard Alumni Association and our production staff for all of their help. If you want to hear more about Harvard faculty on climate research and solutions, we invite you to subscribe to the Harvard Climate blog, and the link is in the chat. Now, here's a bonus. This is our last one of these for the year, for the academic year, but here's a bonus. If you're a Harvard alum and if you're interested in this stuff and you're planning to come to Alumni Day on Friday, June 6th, the Salata Institute is hosting, in conjunction with classes of 85 and 75, a couple of back-to-back events. Hope to see you there in person. The details and registration are in the chat. And it is a beautiful day, as you can see from my background in Cambridge. However, it will be 85 and raining on Friday. So bring your raincoat and your umbrella. And I look forward to seeing you, and I look forward to seeing you virtually in September when we restart this series. Thank you both.
Thank you.
Thanks so much.